What's going on, everyone? Welcome back to another video. In this video, I'm going to be covering what I believe is the two best indicators any trader can use, and that is exponential moving averages and the TDI indicator, which is the Traders Dynamic Index. I've been using these indicators just for over a year now since I joined ASFX, and it has been a complete game changer in the way I view the market and how I can develop and dig deep, getting the bigger overall picture, what the market is trying to tell me. It helps with making trading decisions, it keeps me on the right side of the market, and everything else in between, building my confidence, taking the signals that they present. So what I'm going to show you in this video is talk about exponential moving averages. What are they? How to use them? What are the best periods to use? So is it the 8 EMA, the 21, the 200, the 800, the 8? Whatever it is, I'm going to cover it in this video. I'm going to be focusing on 5 of which I believe is the best universal moving averages you can use. So I'm sure you're gonna get a lot of value out of this video. When I joined ASFX, this is kind of the bare bones of the ASFX strategies. So I didn't know much about exponential moving averages when I joined. So I did a lot of research, developing my knowledge on exponential moving averages and all the other moving averages as well. The main reason behind moving averages is it helps remove all that market noise that the price action can kind of throw at you. So using the EMAs, we can help find trends easier. We can find important key levels in the market much more simpler, and everything that generates that noise in the market, the moving averages, the best way to explain it is it smooths out the price action. So without me rambling on too much, let's jump into the charts and let me paint you a picture, show you how to use the EMAs and what they mean, going over 5 EMAs like I was saying before, the 8 EMA, the 21, the 50, the 200, and the 800 EMA. And we're gonna just show you how powerful they are, how price action responds to these moving averages, and how we can generate high probability trade signals using them. All right, so let's jump into it. What you can see in front of you is the 1 hour chart on GBP USD. And what you want to do if you're using TradingView, I always use TradingView for my technical analysis. And at the top here, you can see indicators. Simply click on that and type in moving average. You'll see moving average exponential. Click that one. You'll then see a line pop up on your chart. It may be blue or a different color, but it all represents the same thing. And now on the inputs, you can see the length. So the default is a 9-period exponential moving average. What that 9 means is it's gathering data from 9 candles previously. So 9 1-hour candles. So this line smooths out 9 hours worth of price action. The exponential moving averages we're going to be focusing on is the 8, the 21, the 50, the 200, and the 800 exponential moving averages. So what I'm going to do instead of using the indicator, if you head on over to Austin Silver's YouTube channel, we have indicators with all 5 of those exponential moving averages pre-built into one indicator. So if you go to his YouTube channel, I'll put the link in the bottom or somewhere up here, and you'll be able to go check that out, and shows you how to set it up within TradingView. So what I'm going to do now is go into the settings and simply add the 8 exponential moving average. What you can now see is this cool yellow line representing 8 1-hour candles previously. The main purpose of an exponential moving average is it smooths out price data and removes most of the noise inside the market. An exponential moving average places more significant weight on more recent price data, which makes it really good for day trading and short-term trade signals. The main use for moving averages is, like I was saying before, to smooth out price data, and more importantly, it acts as dynamic support and resistance. So if we analyze what price action is doing around these lines, the moving averages, you can really get a bigger understanding of what's happening into the market and react to what the market is telling you. So coming back into the charts, we have the 8 exponential moving average, and what that simply represents is the buffer line. It is a very short-term trend of what's happening inside the market. So how do you use this, and what's the point of it being on the chart? If price breaks above it, it is a strong short-term trend. And if price holds the 8 EMA, so you can see in this example here, you see price indecision candle. Let me just zoom in so you can see this a bit better. So you can see price breaks above the 8 EMA. We then retest it with this wick over here. We hold outside the 8 EMA, indecision candle, come back down, we retest it, strong candle, engulfing, bullish engulfing candle off, and then we have this strong momentum move. And then coming back, you can see that we pin it again with an indecision candle. We break below it, indecision candle, pin bar, pinning above it. We break back above, indecision, and then we have this strong bearish bar closing below it. We see we retest the 8 EMA again with this indecision candle here, strong bearish bar, and we roll over. Now, looking at it in hindsight, why the candles have already printed is not the same as watching it being printed in live market data. I believe watching the candles print and how they react to these specific lines, watching the momentum and everything with the candles, gives you a much bigger picture of what's happening in the market. As a day trader, and I'm sitting in front of my charts analyzing what price action is doing and how they're reacting to these candles, can really give me a lot of insight about what's happening and what the market is trying to tell me. So now let me add the 21 EMA. So I'm just simply going to click on the yellow line and add the 21 EMA. So this is the 21 exponential moving average. This gives us 21 hours of price action, 21 previous 1 hour candles. Now, this simply gives us a little more detail. The 21 EMA is simply represents the first line of defense. What that means is if price breaks above or below, similar to the 8 EMA, but more significant on the 21 EMA, you will see a much stronger reaction if price breaks the 21 EMA. So just looking at the charts and looking at an example, you can also see the EMAs crossing each other. So the 8 crossing above the 21 or the 21 crossing below the 8. And in this example, they generate trade signals. So you can take advantage of these crosses, and that is a very profitable trading strategy. Now, of course, you just don't trade the 8 and 21 cross. There's obviously other parameters and confluences you need to stack on top of that. But in this example, just to demonstrate how they work, you can see the 8 EMA, the yellow line crossing below the red 21, and you can see the downtrend continue, the short-term downtrend. So you can see markets holding outside the 8. So when I reference and say holding the outside, the 8 EMA, I mean price isn't breaking back above with bodies or candles breaking above. So you can see it's still holding here because a candle didn't break above the 8 EMA, it only just wicked it. So you can see a few wicks here, and now we are breaking back above, and then we hold back below it as well. And now coming back over to this example here, you can see we break above the 8 and 21 EMA. We have that shift, and price goes into a very short little kind of pullback, and then it follows the overall trend again. Now to get the bigger overall trend as well, now let's add the 50 exponential moving average. Now we have on the charts is a 50 moving exponential moving average, and this is the bias dictator. This will give us the overall bigger short-term trend of what's happening. So as you can see, price is clearly in an uptrend. We are moving from the bottom up to the right. And to use this EMA, the 50 EMA, the power of it is it can generate very strong trading signals and trends. So as you can see, when you stack them up and they all align, and when I mean alignment, I mean in an uptrend, you'd want to see the 50 on the bottom, followed by the 21 on top of the 50 and the 8 on top of the 21. This would be a strong short-term uptrend. And as you can see, price is moving up. We get that pullback, price breaks back above. We get a bit of consolidation in that pullback, price breaks back above. So it's holding the 50 EMA very strong. Moving on to this example just a bit further right, you can see that short-term uptrend we had. Now coming over, you can see we had this bar that broke the 8, the 21, and the 50. You can see the EMA crosses, and now you can see the 50 on top, the 21 below the 50, and the 8 below the 21. This represents a strong short-term downtrend. And you can see price comes down. What happens is we get this pullback. So price downtrend, pullback, continues the downtrend because the 50 EMA is staying on top. And then we just get some ranging and consolidation, and the EMAs are all choppy. So now let's move on and add the 200 EMA and the 800 EMA. So the 200 EMA, which is this white line over here, and the 800 EMA, which is this darker blue line down here. The 200 EMA represents the trend confirmation. You really don't want to be trading when the 200 EMA is going straight across price action and you get all the EMAs choppy, and then you have, the 800 down here. This is a very choppy market, as the EMAs are telling you. What you want to see and how to generate those high probability trade signals and catch that momentum is coming back and looking at this. I know in hindsight it looks easier, but you can still do this in live market as well, because you are simply watching the EMAs as an indicator. This is a great example to show you because we have a full trend coming into play. You can see all the EMAs are in alignment, market is ranging. We then start to see the EMAs fan out, and you see the 800 on the bottom, the 200 on top of the 800, followed by the 50 on top of the 200, the 21 on top of the 50, and the 8 on top of the 21. This represents full trend. So when you have the 200 EMA, which is the white line here, representing the trend confirmation, and then you have the 800 EMA down here, representing the higher time frame trend. When you get a strong confirmation candle like this, breaking above the consolidation period, you can really take advantage of that momentum. And it just tells you the bigger story of what's happening, and you can really stack that confluence into your favor and take these trades with complete confidence. So now let me take you through the TDI indicator, which is the Traders Dynamic Index. This indicator in confluence with the EMAs can generate some very high strike rate trade setups and really help you shift probabilities into your favor, taking advantage of high probable trade signals. So what I'm going to do is just go to settings, and I'm going to turn on the session break, since I'm now on the 15-minute time frame, taking advantage of intraday trading, day trading as you will. And this is how we trade in the AceFX with the AceFX systems. So now I'm going to turn on the AceFX Asia range. So this is simply the Asia session range. Asia session trading. We don't trade in the Asia session, some people do. I find that volatility and volume really kicks in the London session, and this is where the trading systems really kind of show their magic. So coming forward, let me take you through the TDI real quickly. The TDI is a indicator, which is an RSI indicator with two moving averages. The RSI indicator is simply the green line. Then we have this moving average, which is the red line. And then we have another moving average, which is the yellow line. The main two things you want to focus on, or the main thing you want to focus on with the TDI indicator, TDI index, is the yellow line, which represents market sentiment. If it is above the 50 value, you are simply looking for long opportunities. And if it is below the 50 value in the sell zone, you're looking for shorting opportunities. So above the 50 is the buy zone, below the 50 is the sell zone. It's as simple as that. What we like to see is the start of the trading day, we have the L50 either in the buy zone all day or the sell zone all day. And that will just shift probabilities into our favor even more. Now, another thing we look for is the price that breaks out of the Asia session range. So if I just go forward here, you can see we have this breakout of the Asia session range. And one thing I just want to point your attention to is look at the EMAs. Like that example I showed earlier, the 800 on the bottom, followed by the 200, the 50, the 21, and the 8. So this is a very strong trend. Now, to add that confluence with this TDI indicator in the buy zone all day, I'm very long bias. I've gotten my long bias from stacking these together. Now reacting to price action, I can now take advantage of this signal. So at the candle close, because the market is telling me the bigger story, I have overall direction bias. I can see the strong uptrend. We've had this pullback. Now, if you were paying attention earlier in this video, I referenced the 21 EMA as the first line of defense. And as you can see, as we come down below it, we did break below the 21 EMA, but like I was saying, price isn't going to react to these key levels all the time 100% accuracy. But you can see by price action, we had this massive breakout. So the 21 EMA being the first line of defense with this strong uptrend, the TDI indicator telling me it's in the buy zone, I have a long direction, I will take advantage of this signal. So at candle close, I'll put a buy market order, I'll put my stop at the low of the candle, and now let's just see what happens. You can see that momentum picks up, and in real time, if you are paying attention and watching the charts, simply look, if you had this pullback, you would probably be freaking out, but look how it reacts to the 8 EMA, the buffer line. It pins it, and then we get that indecision candle. we get another indecision candle after that, and now we get follow through. What is it doing? It's holding outside the 8 EMA, which is a strong short-term trend. You can see price comes up, still holding outside. We pin it. We've gotten just about 1.5R out of this trade. We did not break below the 8 EMA, so this is still bullish. The buffer line hasn't been broken yet. We get more momentum. Trade's currently at 2.5R, and we just keep reacting to these moving averages with price action. We can see we're retesting the 8 now, we're retesting it, and now we break below it and we break the 21. And what happens is we're retesting the first line of defense and we get another bullish candle off it. And now you can see the market is following through to the downside because we've had that break of the 21 EMA. So as you can see, adding all these confirmations and confluences in your favor, stacking all those EMAs, fanning out in full trend, taking the TDR indicator in the buy zone, giving you your directional bias, gathering the Asia range, seeing the price break out of this range off the 21 significant EMA, which is the first line of defense. Price couldn't break below it or hold it. You can take advantage of very high probability trade signals, and you can even use them to manage your trades. So if you saw this coming down if you're watching it in real time, you would simply see that, hey, price is just gonna pin it and we close above it. So you're not gonna freak out. You're gonna be more emotionally stable during your trading, and you just manage your trade as it goes. If it broke to 50, maybe you'd wanna be out, or if you set targets at 2R and you pace your trade out, which is what I personally do. So at 1.5R, I will put my stop loss in profit, and I'll take 50% of the trade depending on what grade I give it. And then I'll take another chunk of the trade off at 2R, and then I'll pace it out, reacting to the trade using trade management. If you have any more questions of how we use these parameters in the AceFX systems, don't hesitate to drop a comment below in this video, and even reach out to me on Instagram, and I'll be sure to help in whatever way I can. Using the AceFX methods, being able to stack multiple parameters in your favor doesn't just help you find the higher probability trades, but it helps you be more selective as well. So you're not just taking trade setups here, there, and everywhere. You are reacting to what the market is telling you using very strong indicators. In my opinion, exponential moving averages are a very great insight into read the story the market is trying to tell you. So I hope you guys got some value out of this video. If you did, please smash that thumbs up button. Don't forget to subscribe to my channel and hit that bell icon as well so you get notified for any more content I release in the future. I know this video has been a long one, but I appreciate you all sticking around, and I'll see you in the next video.